We think that the overall global share markets can continue to rally in the very, very short term on the back of QE still being available. We've got interest rates very, very low globally, so that's certainly very, very strong points for the share market continue to rally in the short term. We put question marks, however, on calendar year 2014 for the share market, particularly in Australia, where we'll start to see talk of, if not interest rates going higher, which is generally a negative for the share market, as well as unemployment starting to sneak a little bit higher, unemployment starting to go a little bit higher as well. So we're quite cautious on the outlook for the share market as we move forward into 2014, particularly with earnings growth not coming through as we had expected. We're stock pickers, so we do really drill down on the Australian market in a lot of depth and do a lot of in-depth research with our team of 5 here. So we certainly attach a high weight to interest rates, particularly unemployment. Change of government could be positive for the share market and consumer sentiment, so we're watching that quite closely as a theme at the moment. But certainly, generally, the share market does tend to struggle with interest rates going higher, and we've seen it again in the last 6 to 12 months when interest rates are going lower. That tends to go well for the share market, and particularly those deep industrial cyclical companies that are tapped into the housing and all retail sector. I think it's still quite early, James, in terms of the housing recovery. So a lot of the talk of a bubble in the Australian housing market we think is a little bit premature. It is still quite patchy, and the Sydney market is the strongest housing market in Australia at the moment. Melbourne is recovering off its base. Queensland is coming off its lows. Western Australia and South Australia are quite flat. So it does remain quite patchy, and it's not an overall, the overall market isn't strong in terms of housing. What we're watching for in 2014 is an uplift in the housing starts. So all the talk at the moment is more in the secondary market, so existing product moving at much higher rates, generally 10% higher versus last year. So we're keeping a close eye on how the building starts will go forward over the next calendar year, and we're certainly positioning the portfolios to take advantage of that.